there are some early signs of some risks that we're worrying about, and that's particularly on what we call high debt-to-income lending.
Everyone told you it would crash. They said interest rates would crush borrowing capacity. They said the cost of living would force people to sell. They said the fixed rate cliff was the end. The Australian housing system is standing as a defiant economic anomaly. While you've been watching the Reserve Bank tighten the screws, something else has been happening beneath the surface. The money didn't stop flowing, it just changed pipes. This is what we call the hydraulic state. When regulators squeeze the big banks, the cash simply diverts into the shadow banking sector, a vast, opaque network designed to bypass the rules. In this video, I'm going to show you the mechanics of this hydraulic effect. We'll look at the shadow banks doubling their loan books, we'll expose the government's secret addiction to high prices, and I'll give you the roadmap for 2026, where a perfect storm is about to trigger the return of the fear of missing out. Let's get into the data. The main regulator is APRA, the Australian Prudential Regulation Authority. Their weapon of choice, the serviceability buffer. Currently, banks must test if you can repay your loan at an interest rate 3% higher than the actual product rate. This single rule destroys borrowing capacity for the average family by roughly 25 to 30%. APRA says this is for your safety. They claim it prevents systemic banking collapse. But here is the catch. According to APRA chair John Lonsdale, in late 2025, the buffer had not been restrictive on new credit to the household sector. How can that be? Because it only restricts the standard borrower. It restricts the employee with a PAYG slip that wants the lowest possible interest rate. And then there's the DTI limit, the debt-to-income cap, introduced to stop people borrowing 6 times their income or more. The media called it a crackdown. But the data shows it's a paper tiger. APRA set the cap at 20% of new mortgages. But APRA explicitly admitted that at an aggregate level, the limit is not currently binding because most banks had already retreated from high DTI lending. It's regulation designed to signal vigilance without disrupting the market's momentum. These calls were for show, something they know will appear on the 6 o'clock news to prove they're doing something. The reality is, it's no handbrake. People find a way. So, if the big banks are sometimes saying no because of APRA, who is saying yes? Enter the shadow banks. These are non-bank lenders. They don't accept deposits, so they aren't regulated but by APRA in the same comprehensive manner as banks. And this is where the hydraulic effect kicks in. According to the RBA, the value of new home loan commitments by investors through non-ADI lenders surged by a massive 44.6% between December 2023 and December 2024. Why? Because non-bank lenders use different math. While the big banks force you to pass a 3% stress test, many non-banks apply a buffer of only 1.0% to 2.0%, and some take your actual repayments without adding any buffer. For a typical family earning $150,000, the difference between a 3% buffer and a 1% buffer can unlock an additional $100,000 to $150,000 in borrowing power. That is the buffer arbitrage that allows non-bank borrowers to outbid bank finance buyers. It gets wilder. Self-employed and can't prove your income with 2 years of tax returns? No problem. Non-banks offer alt-doc products that accept business activity statements, accountant letters, or even bank statements. Lenders like MA Money have lease doc options, where a commercial lease agreement alone serves as proof of income. Asset Line Capital has capitalized on market friction by offering no-val loans for rapid settlement. This isn't fringe stuff. MA Money doubled their loan book to $4 billion in under a year. The shadow sector is now the primary structural reason why borrowing capacity has continued to expand despite official interventions. But how do borrowers find these shadow lenders? They don't. Their brokers do. Mortgage brokers now facilitate 77.3% of all new residential lending in Australia, a record high. This includes non-bank lending. They are the gatekeepers of credit. And they have new tools. Platforms like Quickly allow a broker to automate maximum borrowing calculations across hundreds of products. If a major bank rejects a client due to the 3% buffer, the broker has a financial imperative to find a lender who will say yes. This broker industrial complex ensures that regulatory tightening at the ADI level is almost immediately circumvented. Yes, these non-bank lenders have higher interest rates of 0.5% to 1%. But because they have a tiny repayment buffer, the borrowing capacity is so much higher. Many home buyers, including investors, are happy to pay the extra $5,000 in interest if it means they get a better property with higher returns. Now, you might ask, why doesn't the government stop this if they're serious about property prices? Yeah, they're not. The evidence suggests that the government views a fall in house prices as a political and economic catastrophe to be avoided at all costs. Housing Minister Claire O'Neil said it plainly. We want to bring house price growth into something sustainable, so we're not trying to bring down house prices. Former opposition leader Peter Dutton echoed this sentiment, stating his desire for house prices to steadily increase. The state governments are addicted to the cash generated by a booming property market. In New South Wales alone, revenue forecasts were revised up by $10.7 billion, largely due to higher transfer duties. A fall in property prices would blow a hole in state budgets. So, instead of fixing supply, they pump demand. Schemes like the Help to Buy scheme allow marginal buyers to bid more for the same property. The expanded First Home Guarantee, which allows a 5% deposit, unleashes a wave of demand. Domain predicts this scheme alone could lift prices by 3.5% to 6.6% in its first year. So, what happens next? If you are waiting for a crash in 2026, I have bad news. Domain's comprehensive forecast outlines a two-phase prediction. Phase 1 is the pull forward, January to June 2026. The government schemes will trigger a rush, as first home buyers fear they will miss out. This stimulus alone is predicted to lift prices. But Phase 2 is the real danger. Financial markets are pricing in RBA interest rate cuts for mid to late 2026. A 0.5% reduction in the cash rate typically increases a household's borrowing capacity by approximately 5%. When combined with the aggressive lending criteria of non-banks, this will reset the ceiling of what buyers can pay. The first rate cut will likely trigger the massive psychological shift, the return of fear of missing out. The Australian property market is an ecosystem engineered for resilience. When APRA places a rock in the stream of credit, the water does not stop flowing. It simply diverts around the rock, carving a deeper channel through the non-bank sector. The government acts as the custodian of high prices. For the Australian homebuyer, the lesson of 2024 to 2026 is clear. Waiting for a crash is a bet against the combined will of the banking sector, the shadow lenders, and the state itself. Please click the subscribe button. Your support is vital in keeping up our motivation and sharing these videos with everyone.